Accounting for receivables. According to the ACCT textbook, receivables are an amount owed by a customer who has purchased the company's product or service. In simple terms, it's money that a company is owed by someone else, whether it be a person or another business, when they buy something without paying upfront. This is called on credit. Accounting for receivables is the way businesses keep track of how much money they'll lose to people who won't pay them back. This is key to running a business, as the company needs to know how much money they can expect to actually receive. Receivables are counted as an asset, however, it doesn't mean that the company has the money on hand to use. A company which doesn't keep track of how many receivables are returned will quickly find it's losing money. There are two ways to record receivables when the company deems that they'll no longer be able to collect the money, so an uncollectible receivable. Uncollectible receivables are an expense because when someone doesn't pay you back after they use a service or take a product, then you lose the money. It's a bit like lending someone your book but never getting it back again. You know you're not going to get it back, so you lose the money that the book was worth. The first method is by direct write-off. This method basically just writes off the uncollectible when the company decides they're not going to get the money. It's very easy and only requires one journal entry, but it violates the matching principle. This principle states that the expense has to be recorded when it's incurred, but when the sales are made on credit, you don't know that it's going to become an expense. By recording the expense in a different period, this violates the matching principle, so the direct write-off method is usually illegal unless the amount is immaterial, or you're a big enough company that a few $100s don't matter when you make decisions about the company. The other method is the allowance method. This method needs two journal entries, one to estimate how many of the credit sales in the period are bad, and another to write it off afterwards. The first thing you need to do at the end of the period is make an allowance for bad debts account. This means that once you've sold all your credit sales for the period, you can estimate how many you won't get back, and that's your allowance for bad debt expense. There are three ways to estimate bad debt expense. The first is by percentage of sales. This method takes a percentage, which you've figured out from previous experience of your total sales, and uses that to estimate your bad debts. The second is by percentage of receivables. Like sales, this takes a percentage, which again you've calculated from previous experience, but instead it multiplies it by the number of receivables you have rather than the sales. The last is the aging of receivables method, which takes into account the idea that the longer a person doesn't pay, the less likely they're going to in the future. Using one of these methods, you first estimate the expense. Your expense depends on the balance of the account from the previous period. Either you wrote off more receivables than you expected and went over your estimate, so there'll be a debit balance, or you wrote off less than you expected and there's money left over, so you have a credit balance. If you went over, then you have to allow more money this year, but if there was money left over, then you can reduce the money you put aside this year. Then, when you decide the money is uncollectible, you write it off the same as a direct write-off. Thank you.